Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And from time to time, I have my good friend Tori in here, and from time to time, I have my good friend Rob in here. And this is a different sort of time today. So we'd like to thank our producer for throwing an extra microphone in here. And things are going to get a little crazy because there are three of us sitting here today. So
with a lot to talk about.
That is true.
Too much to talk about. How do we pack it all in? What
10
do you
pounds
say?
of mud, 2 pound sack, buddy.
There you go. That's our objective today. This is like the good old days.
The good old days where we used to have the extra microphone in here.
Yeah.
So this is going to be fun for us, so hope you guys enjoy as well. And like I said to start us off, welcome to Golden Rule Radio. Where would you guys like to start today?
Well, we have this discipline of trying to start with gold. All roads lead to gold, as we often say in this program. So looking at the chart, and there has been quite a bit of a pullback here the last couple of days. We'll get into why we think that is, but do you want to just start with the imagery?
Sure, we can certainly start where I think, Rob, you and I were talking a couple weeks ago when we were coming into that 1980 number. And I know one of the big things that I brought up when looking at the chart is that 1980 number not only was the neck of the high looking back in May. You know, when we got up to almost 2100, we had this dip in the middle right around 1980. And then when we started to fall and broke back down below it on our way to 1900, we had a little peak put in there at the beginning of June. So we came back up to that 1980 number, and what did we say a couple weeks ago? If we're going to continue this, if it's breakout territory, that's the number. We have to see some things get above that previous high at around 1980. So it's not surprising that we've seen a little bit of a ceiling here and a little bit of a drawback down. That doesn't mean we're reversing back down, because now we have to get below 1900. So any trading in that almost $100 range is just going to be sideways trading, even though $100 feels like a lot.
Well, and I still like 1910 as a floor. I think that's a good floor over time.
Wouldn't be the first time we've seen a double bottom as things are moving up.
Right. But we're out of that seasonality, that doldrums for the summer. We have moved out of the seasonality slow period for gold. Looking at the technicals, and boy howdy, looking at Tori, we've got a lot of fundamentals that will be affecting the price of gold as we go forward for the rest of this year.
Oh, yeah, and have been, quite honestly, not the least of which is the dollar and its recent movement, but the dollar can react too. The bond market is the king of all markets. The bond market's got a lot of volatility. What happens when bonds get crushed like they did yesterday on this downgrading of the U.S. federal credit rating? We'll get into that too. But of course, the Treasury yields are going to spike. Gold's going to go down, which is what we've seen here in the last couple of days. And that little bit of a dollar rally that we've seen here, it's now at a 3-week high. That coincides with the recent further decline closer to that 1910 figure that you guys are talking about. Where are we? 1,935 as we record here on Wednesday afternoon. So yeah, there's, again, that's some of the mud we got to try to pack into today's show.
Well, and the real estate's beginning to show some decline, and the equity market has come down as the dollar has traded back up towards the top end of its pretty long-term trading range. And we'll look at that when we look at the DXY chart here in a minute.
Yeah, Rob, as you often say, the dollar is just the healthiest horse at the glue factory, if you will, or whatever you say. We all know its demise, and that all has to do with debt, and it has to do with the money supply, which you have spoken about ad nauseum on this show before, just showing the charts, Rob, on the money supply and what that does. But how about even the central bank balance sheet?
Well, and right now it's declining, but they just rolled out their fourth quarter estimate of what they need to borrow. And the fourth quarter, they're going to borrow close to $1 trillion. So the deficit is going to be 2.4 something trillion for 2023. Where is that going to go? It's not a great thing to have your AAA rating downgraded to AA as you are upping your borrowing.
That's right. And not only increasing your borrowing, but the debt service on that money that you're borrowing, the interest rate is climbing. So
right, close to $1 trillion.
Yeah, just to service the debt. So the debt has grown now and ballooned over $32 trillion, 32.7 really. And think about what you just said, 2.4 this year. Okay, we've got 1 quarter left in the fiscal year, ends at the end of September. And they think that between August 1st and September 30th that we're going to add $1 trillion to make it the 2.4. That's not reasonable policy. And the reason that Fitch downgraded is because they don't believe that Washington has the ability to really come together and solve this problem. It's a legitimate problem that is ramping up. It's accelerating. There's no end in sight. There's no debt ceiling to hold them accountable between now and January 2025. So you're right. Where does that go?
Yeah, and I believe it will show up. Some of that's going to start showing up in the balance sheet, because with the de-dollarization happening globally, the BRICS are soon to announce their currency with some kind of gold and natural resource backing. That's going to suck some air out of the room, and the dollar is topping out. And then, of course, you're looking at the stock market. The S&P price earnings ratio is over 30 to 1. That's very rare. That's almost as rare as the U.S. AAA rating being downgraded to AA.
Yeah, this is now, what, the second time, and the first time was in 2011, which, again, it was deserved then too. But, Richard Francis is the lead analyst on the U.S. sovereign ratings at Fitch, and he's getting all sorts of pressure, being accused of this being a political move or something else. And he said the numbers speak for themselves, and they do. The concern is legitimate when you've got those sorts of numbers that they're talking about, and then obviously you've got up 170% year over year. It's not just that we're 1.4 so far this year. That's up 170% from this time last year. So that's that acceleration that we're talking about. And the Treasury Department saying, yeah, but all these economists are coming out saying, quote, this is arbitrary and based on outdated data. That comes from Janet Yellen, right? Jason Furman says it's completely absurd. Larry Summers, who gets quoted every time the word economy comes up, says it's bizarre and inept. What are you talking about?
Well, this reminds me, what was it, 8 months ago when we crossed the threshold of what the generally accepted definition of the word recession is, and then the White House put out that press statement like, it's not technically, even though it was technically a recession. That's right. They're like, well, if we change the definition, then it's not a recession. Yeah, it's very frustrating, and I know we were joking about this before we started recording, but I always say politics has kind of become its own bread and circuses. We attribute everything to political turmoil here in the United States, and not everything needs to be political. I don't understand the conspiracy theory around everything is politically motivated by one party attacking the other party or vice versa, because we're watching the whole house of cards fall down and everybody's trying to point fingers instead of grab buckets of water.
Well, to quote the deep thinker Frank Zappa, politics is just the entertainment division of the military-industrial complex.
Fair.
Well, we're being entertained.
Yeah.
I'll tell you.
Are you not entertained?
Oh, goodness. Okay, which of these are not true, all right? Primary reasons for this. Fitch expects the general government deficit to increase to 6.3% of GDP just this year. It was 3.7% last year. Oh. We're already sitting on so much debt that it's between 118 and 132% of GDP. Those are scary numbers.
Okay.
And their biggest concern is that nobody's doing anything to address it, and they can't come together. But these three things: cyclically weaker revenues, true. New spending initiatives by this administration.
True.
True. Finally, higher interest rate burden. True. That's what they're doing. So those three things ought to result in a downgrade when you're spending more than you're taking in.
I have nothing funny to say. It's not funny. It's getting serious.
Right. Well, and you brought up the central bank balance sheet a minute ago, so I think it's worth looking at those numbers. Obviously, the central bank is going to pop up the balance sheet, this spring, in response to the Silicon Valley Bank. So we have finally, the first month since, we're back down to where we were pre-Silicon Valley Bank numbers. But we're still talking about, since March of 2022, we've gone from 9 trillion to 8.25. But in that same period of time, interest rates have gone from less than 0.5% to where are we at now as of last week? 5.25
to 5.5.
Yeah. So we've had this significant increase in additional expenditures, as you guys were just talking about, coming out of the government with diminishing tax revenue. I know we talked about this over the last couple weeks, and you brought up the deficit difference, looking at a little over $4 trillion in revenue for the government and quite a bit over $6 trillion in expenditures, and increasing expenditures going forward. There's no intention whatsoever of anything that resembles austerity going forward. And the problem is, the more the U.S. citizen, taxpayer, employed person gets squeezed at the pump and squeezed at the grocery store, those tax revenues are going to go down. So we're increasing expenses. We're increasing the cost of borrowing by the federal government. We're devaluing the value of those bonds to begin with from AAA to AA. And the American taxpayer is not going to be able to fit the bill while we continue to bicker over whatever political agenda we think our enemy might have. Like, it's incredibly frustrating position to be in if you're not able to detach yourself from your emotional position, like you were talking about, Tori, and say, look, these are the numbers. Can we just accept that numbers are numbers? There's no emotion attached to numbers.
That's right. And really, it's actually encouraging from the standpoint of what we do. I hope we see the 1910, right? We're at 1935. Awesome. Wouldn't that be great?
That'd be awesome.
What do? You just position in physical gold.
Yeah. And we may get there, but I don't think this dollar rally is going to be long-lived with all the news that's popping up just today.
Yeah.
I think that's short-lived. I think the Dow looks a little toppy. We need to go to the Dow chart and take a look at that.
Oh, we can definitely do that. So the Dow has seen what looks like at least a short-term, if not a reversal position over the last couple of days as it came into what I like to call a failure to return.
Yep.
So if you go back to where the Dow peaked out, we had a decline in the Dow. Now this, I'm talking like a year or so ago. We had a decline in the Dow. We had a bounce back up, and it failed to get back to the old highs. So if you look at where that top is compared to where we just got to, it's a completely reasonable place for the Dow to see some resistance and turn around, especially as the Dow and the NASDAQ and even the S&P as a whole has had such a significant rebound over the last number of months. So it sounds really good when you're a bobblehead on TV talking about how great the Dow's been doing for the last couple of months, but we're still, depending on the indicator, 3 to 6% below the old highs. And it looks like you said, running out of steam.
Yeah.
Well, it wouldn't surprise me one bit. And I'm not going to shout into the microphone, but consider this me shouting from the rooftop, just like we did in October of last year. Buy your hedge. This is when you buy your hedge.
Exactly.
Right? You're talking about the market's topping. You're talking about real estate. You're talking about the equities. Metals are such an important hedge on your portfolio when you own those assets. We're not saying don't own them. We're saying, look, you've got to bring some balance and reduce the drawdown for when those corrections occur. And here's gold underappreciated, devalued compared to what? Equities, the U.S. dollar, certainly, that's had this little rally, even bonds, and then now we're talking about even real estate. This is when you buy your hedge. What does it take for you to add to your ounces here?
No, you're exactly right.
Otherwise, it can't work. Your hedge can't work if you're not getting it when it's devalued.
Well, I'm glad you brought that up, Tori, and stop me if I'm putting you on the spot here, but I know you're kind of preparing for something you've got coming up in the next little bit, and we talked yesterday and you had me put some charts together that I hadn't looked at previously, because I think all three of us can say one conversation that I feel like we have regularly when we're talking about hedge, because one of my arguments when we look at our financial triangle concept is I've always looked at gold as dirt you can pick up and put in your pocket and go sell somewhere else. So I'm glad you brought up the real estate thing. As you're getting ready for this, is there anything on the relationship between gold and real estate that you think might be worth pointing out on today's show, and maybe something we can talk about further down the road if people are interested?
Yeah, I love investment real estate. I love hard assets of any sort, something that has ongoing tangible value. There are some obstacles with real estate. One is the liquidity. If you get into a tough market, it can be very hard to unload, whereas other commodities like precious metals, you can unload in any market relatively easily and acquire them easily, right? And they have property taxes and upkeep and some of those things that the metals don't have. So you think, well, yeah, but it's all worth it if the real estate is outperforming the gold.
Doesn't it make up for it if you're looking at significantly better investment return?
Right. So that can be argued, but is that really the case? If we go back to when our company was founded and look at the performance of gold versus the performance of real estate, you think, goodness, think about what you could buy the average home for in the United States back when, Rob, I think you were in college.
High school.
1975.
I was high school.
1972.
Yeah. It's a nice house for $35,000 or whatever, right?
Right.
I mean, so since then, the average home prices are up 1,715%. That's a huge gain. Unfortunately, it's dwarfed by gold's 4,566%. And it's just sitting there. You don't have to do anything to it. You don't have to manage. You don't have to pay for it. You don't have to pay a tax on it. And so keep that in mind. But now, to be fair, there are windows here where real estate certainly outperforms gold. And that's why we're talking about it being a hedge and bringing balance.
Well, but what's something a little more realistic for someone like me in my 40s who wasn't alive back then?
Right. That's right.
So, and that's where when we started looking at these numbers, well, okay, so you look at real estate compared to gold since the early 90s, and it's almost identical. So there's no benefit whatsoever one or the other except for, like you said, continual tax expenditures. And what we're looking at is single-family properties compared to gold. Well, but then you look at it from, say, 2000, because we've had two major real estate booms over the last 25 years. We had the one right before I came to work here, like 04, 05, 06. Mm-hmm. And then, frankly, we've had a pretty significant real estate increase over the last couple of years as well, as people knew interest rates were going to start going up and they wanted to get in at the last minute. So you would assume real estate over the last 20 years has been exceptional. But realistically, when you look at real estate starting in 2000 compared to gold starting in 2000, real estate up about 200%, gold up 578.
Yeah.
Pretty good for a pet rock.
Not bad. So you open this by saying, I love investment properties. Yeah. And you know what real estate does that gold doesn't do? Residual income from rental.
There you go.
But you know what gold does that real estate doesn't do? Liquidity and transportability.
Yeah. And privacy. And again, not bad-mouthing one or the other. This was just an eye-opening balance.
That's the point of this.
Complementary.
Yeah, and I had a great conversation with a client yesterday about this exact topic. They're both foundational assets. One leans a little bit more towards the left side of the triangle, which is more investment motivated. One leans a little bit more towards the right side of the triangle, which is liquidity motivated. But they're both phenomenal complementary assets. So don't think gold replaces real estate or real estate replaces gold, because that is a conversation I feel like I've been having often over the last couple of months. So that's why I'm glad you brought it up yesterday, and I thought it was worth talking about.
Same thing with your cash in the bank and gold. Right, Rob? How many of those conversations have you had in the last week?
A lot. And we have an alternative for people with the vaulted program. They can have access to their money in 2 days.
Yeah.
So the vaulted program really fits well on the right-hand side of that triangle. It's liquid, it's physical gold, and you don't have to ship it off and wait 2 or 3 weeks to get your money back. You have your money back in 2 days. We have so many options for people. It's like I'm fond of saying, the metals market is a lot like a golf bag. There are so many clubs that people can play. They just need to get in touch with us, and we can go over all their options.
No, it's a great point. And the banking sector is not fixed. We're giving so many bank ratings. And to me, the takeaway is, look, deploy your money, whether that's in real estate, whether it's in a productive asset, other tangible commodities, precious metals. It doesn't need to be sitting in the bank. There's certainly, Miles, you're just saying liquidity and opportunity. You don't ever want to be completely cash poor. I'm not saying that either. But what banks used to bring to the table, they no longer bring to the table. You're an unsecured creditor now with bail-ins and everything else. Get the money out of the bank. It's an overexposure that's guaranteed to lose. You know, you're losing purchasing power in your currency. It's a hidden theft. Your cash is robbing you. At least be in a slightly productive or more productive asset is my takeaway.
Yeah, it makes total sense. I mean, in 5 years from now, regardless of what the dollar does, which I think we all know what the dollar will look like in 5 years, your gold will still buy in 5 years what it does in terms of food on the table, gas in the car, going to the doctor, because those are all going higher. The cost of goods and services are definitely going higher, and so will gold. And it'll maintain your purchasing power, and you can get to it and liquidate it easily and have options. And that's what I am concerned about, is a lot of people get stuck in the markets or in real estate or in gold. People get myopic as opposed to just understanding that gold itself is just capital. It gives you options. 5 years from now, regardless of what happens to the markets, the bank, the currency, your gold will remain and have value. You can move it, and you will have options. Other items that people are fascinated by, I have conversations with clients that are, well, how do I know what it's worth from day to day? I know exactly how much I have in the bank. And they get fixated on that dollar amount. And it's hard to move from that view of life, money in the bank is safe, to I want it in capital, I want my options open, I don't know what the next 5 years are going to bring, but for that portion of my assets, I know it will be secure.
Well, let's not forget its little sister too, silver. Like, we can't go the whole show without
I knew this would happen with all three of us in here.
We got to put Miles on the spot with some silver charts too. So
sure. And closing out the gold chart, which we started 10 minutes ago. Yeah, I think a 1910 double bottom here, especially with way some of the moving averages are moving up towards that number, looks really good. And I think we are seeing a similar pattern over on the silver market as well. So, yep, silver has come back down, but we're still looking in stair steps up. And until we see a break below back into that 22 to 23 range, I'm going to stay bullish on silver until it proves otherwise. So,
and silver's had a good year.
It has.
Surprisingly so.
Yeah. It had a good year last year.
That big rally that we got from October to the end of the year has almost been completely sustained. We had that 40% pop, and it just doesn't want to give it back. It's surprising.
And I'm a gold bug.
Well, I am too. Yeah. I look at silver strictly as future gold, right?
Silver's up 30% since July last year. We forget, it wasn't that long ago we were at $17 spot price.
That's right.
Granted, it went to 27, 17 to 27, $10. We come back 5. So 2 steps forward, 1 step back. There's a couple little quips you can learn, and you know about 80% of all investing right there. It's just how it works sometimes. So.
Well, the ratio hasn't moved much.
No.
We're kind of pegged at 80, not going anywhere. So even though silver's come down 4.5% in 2 days, it's just ho-hum for silver. That's kind of the normal volatility.
Right.
And they've been following suit. So we'll watch the ratios and keep it going.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, give us a buzz sometime. We're happy to talk with you about your personal precious metals portfolio. We can be reached at 800-525-9556. You can find us on our website at McElvaney.com. We're on Facebook at McElvaney Financial or Twitter at ICA Gold. Thanks for listening and have a great week.